Meet Sandra. She's 67. She worked as a school admin officer for 24 years, raised two kids, mostly on her own, paid her taxes, did the right thing. And last year she retired with $83,000 in superannuation. She thought it would be okay. She'd heard about the age pension. She figured the government would help fill the gap. What nobody told Sandra was that the age pension, even the full amount, isn't enough to cover rent in most Australian cities. Not even close. Sandra is not a rare case. She's not a cautionary tale from 30 years ago. Right now, today, the majority of Australians heading into retirement have less than $200,000 in super, and most of them have absolutely no idea what that actually means for the life they're about to live. Today on RetireScope AU, we're going to be honest about it. We're going to look at what really happens, what the government pays, what it doesn't cover, and what you can actually do right now, whether you're 35 or 62. Because the worst time to find out there's a problem is after you've already stopped working. All right, let's start with what $200,000 actually gets you in retirement. Not the theory, the reality. If you retire at 67 with $200,000 in super and you draw it down at a sustainable rate, your super alone gives you roughly $8,000 to $10,000 a year. Think about that. $8,000 to $10,000. That's under $200 a week. That doesn't cover groceries. Now, this is where most people say, but what about the age pension? And look, the age pension is genuinely important. I don't want to dismiss it. It exists for exactly this situation. Here's what it currently pays. As of March 2026, the maximum full age pension for a single person is $1,200.90 per fortnight. That works out to roughly $31,200 a year. So if you own your home outright and you qualify for the full pension, you're looking at a combined income of somewhere around $39,000 to $40,000 a year. That's your super drawdown plus the pension. For some people, in some situations, that works. But for a lot of Australians, it doesn't. And here's the part the brochures leave out. That entire calculation assumes you own your home, outright, with no mortgage. If you're renting, the numbers completely fall apart. Because what's happening to retired renters in Australia right now is something that most people don't want to talk about. But we are going to. And before we go further, if you're finding this useful, hit the like and subscribe on RetireScope EU. Every week we do exactly this. Real numbers, no fluff, no sales pitch. All right, back into it. I want to share something with you that genuinely shocked me when I first read it. A national survey was published in April 2026, just weeks ago, that looked at Australians aged 55 to 69 who are currently renting. The findings were confronting. 1 in 3 of those renters said their super would last less than 5 years if they had to rely on it while paying rent. 6 in 10 were already in housing stress, spending more than 30% of their income just on rent. And in Sydney, the average rent for a one-bedroom apartment is currently $560 a week. $560 a week. The full age pension pays about $600 a week. That leaves Sandra, or anyone in her situation, with roughly $40 a week for everything else. Food, medicine, utilities, transport, everything. There is a government supplement called Commonwealth Rent Assistance. It's supposed to help. And it does, a little. The maximum payment right now is about $215 per fortnight for singles. But here's the problem. According to Super Consumers Australia, rent assistance increased by just 2% between September 2024 and September 2025, while actual rents rose 4.5% in the same period. The gap between what the government pays and what a rental property actually costs is getting wider every single year. And the people caught in that gap are real people, not statistics. Real people who worked their whole lives and are now choosing between rent and groceries. Now look, I'm not telling you all of this just to make you feel terrible about a situation you might already be in, because there are things you can do. There are levers you can pull, and some of them are sitting right in front of you. But first, let's talk about a rule change that just happened that affects every single Australian with a super account. On the 1st of July, 2026, which is literally this financial year, a piece of legislation called Payday Super came into effect. Here's what it means in plain English. Previously, employers could pay your superannuation contributions quarterly, every 3 months. From July 1st, they now have to pay within 7 business days of each pay cycle. This sounds like a small bureaucratic change. It's not. Think about it this way. If your super contributions are sitting with your employer for 3 months before they land in your account, that's 3 months of compounding returns you're missing out on. Multiply that by a working career of 30 or 40 years, and it actually adds up to real money. For someone currently in their 30s or 40s, this change alone could mean tens of thousands of extra dollars by the time they retire. But, and this is important, this only applies to your employer's compulsory contributions. It does nothing for the gap that already exists if you're close to retirement with a balance under $200,000. And there's something else worth knowing. Right now, the assets test threshold for the full age pension, updated as of March 2026, sits at $321,500 for a single homeowner. What that means in practical terms? If you retire with less than that in total assets, including your super, you qualify for the full pension. So a $200,000 super balance? You'd actually be in line for the full $31,000 a year. That's not nothing. That's a meaningful safety net, if you know how to use it properly. And that's the key phrase right there. If you know how to use it properly. Because there are things most people with lower super balances do that accidentally reduce their pension entitlement. Things that nobody tells them. Let me show you what I mean. Let me tell you about something I think of as the invisible penalty. Say you've got $180,000 in super. You're approaching 67. You're nervous about the money running out. So you withdraw a lump sum early. Maybe to fix the car. Maybe to help one of your kids. And you put it in your bank account. Sounds reasonable. It's your money after all. Here's the problem. Once that money sits in your bank account, Centrelink deems it to be earning income, regardless of whether it actually is. Under the current deeming rules, the first $64,200 is deemed to earn 1.25%. Anything above that is deemed at 3.25%. That deemed income then gets counted in your income test, and it can reduce or even cut off your age pension entitlement. By simply moving money out of super and into a bank account at the wrong time, you could accidentally cost yourself thousands of dollars a year in pension payments. There's another one that catches people off guard. If you give away assets to your kids, to a family member, to help someone out, Centrelink has what's called a gifting rule. You can give away up to $10,000 per financial year, or $30,000 over 5 years, without it affecting your pension. Go over that, even with the best of intentions, and the excess gets counted as an asset for 5 years, whether you still have the money or not. I know someone, mid-60s, good bloke, who gave his daughter $40,000 to help with a house deposit. He had less than $150,000 in super. He genuinely thought he was doing the right thing. Centrelink assessed him as having $30,000 more in assets than he actually had for 5 years. His pension was reduced by roughly $2,300 a year. Over 5 years, that's over $11,000 he didn't need to lose. Now, here's where this conversation changes direction, because I don't want to leave you sitting with problems. I want to leave you with something practical. Because if you're under 60 right now, or even if you're 62 or 63, there are real things you can do that most people don't know about. All right, here's where we get practical. Because if there's one thing I believe after looking at all of this data, it's that the Australians who end up okay with a modest super balance aren't necessarily the ones who earned more. They're the ones who understood the system and used it properly. First thing, and this sounds simple, but it matters more than almost anything else. Know your actual number, not the number you think you'll have, not the number you hope you'll have, the real projected number. Money Smart, which is run by ASIC, has a free retirement planner on their website. You put in your current balance, your age, your salary, and it projects where you'll be. Most people I speak to have never actually done this, and that's the silence that costs them the most. Second thing, and this one is specifically for anyone earning under $90,000 a year. Look at the government co-contribution scheme. If you earn under $58,000 and you make a personal after-tax contribution into your super, the government will add up to $500 on top of it. It's free money from the government, sitting there, unclaimed. Most people earning in that bracket have no idea this exists. Third thing, if you are a homeowner or plan to be, understand the assets test exemption. Your family home is not counted in the assets test. That means if you've got $200,000 in super and you own a modest home in regional Victoria, your assessable assets might actually be well under the threshold for the full pension. That could mean $31,000 a year from the government, on top of your super drawdown for the rest of your life. That's a very different situation to the scary headline number. But the thing that changes everything, the one variable that has the biggest impact, has nothing to do with super funds, government schemes, or contribution strategies. It's something most Australians underestimate completely. Here's a number that I think about a lot. If a 38-year-old Australian with $30,000 in super starts contributing just an extra $200 a month on top of the compulsory employer contributions, by the time they hit 67, that extra $200 a month could grow to somewhere between $90,000 and $130,000. Not because $200 a month is a lot, because 29 years of compounding turns small decisions into large ones. The tragedy isn't the people who retire with under $200,000 because they couldn't contribute more. The tragedy is the people who could have contributed more and didn't know how much it mattered. I think about Sandra from the start of this video sometimes, not to be harsh on her, but to ask, what would have changed if someone had sat her down at 42 and showed her exactly this conversation? The honest answer is probably everything. So let me bring this together, because if you've made it this far, I want to make sure you walk away with something real. Here's what we know. Less than $200,000 in super is not automatically a disaster. If you own your home, qualify for the full pension, and live in a city where costs are manageable, you can build a workable retirement around it. But it is genuinely tight, and for renters, it is seriously concerning. Not because the system doesn't care, but because the system was designed around an assumption that fewer and fewer Australians actually fit. The assumption that you'll own your home outright. The best move, whether you're 30 or 60, is to stop guessing and start knowing. Know what your super balance will be. Know what the pension will add. Know whether you're in or out of the assets test threshold. Know the gifting rules before you help your kids. Know your number, and then build toward it. Because the difference between a stressful retirement and a manageable one often isn't $100,000. It's knowing what game you're playing before the clock runs out. At RetireScope AU, that's what we're here for. Not to sell you anything, not to scare you, just to make sure you have the real information before it's too late to use it. All right, before you go, I want to ask you something. Do you know someone, a parent, an older sibling, a mate at work, who is getting close to retirement and probably hasn't had this conversation yet? Share this video with them. And drop a comment below. I genuinely want to know, what's your biggest question right now about superannuation and retirement? If you haven't already, subscribe to RetireScope AU. Hit the notification bell so you don't miss the next one. Thanks for being here. I'll see you in the next one.